Hey everyone, Alphabet stock is dipping after the company reported earnings, and that has even more investors interested in Alphabet stock. Coming into the year, I ranked Alphabet as my top stock to buy for 2024, and I recently reiterated that recommendation. But in this video, what I'm going to do is give a stock price prediction for Alphabet going forward 2 years. So I'm going to estimate where I think Alphabet stock price will be by the end of 2025. So follow along. Let's take a look at these interesting financial forecasts.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so one of the numbers I'm going to need to make this forecast is Alphabet's current stock price, which is at $142 per share. And here's that dip I mentioned earlier, the price coming down after the company announced earnings that seemed to have disappointed Wall Street analysts. Although when I reviewed Alphabet's earnings, there was some concern in there, although I'm not sure if there was enough in there to cause the stock price to fall by 6 or 7% as it was on the day following the announcements. Although admittedly, Alphabet's stock price had already risen close to 9% on the year. So it could have been that expectations were really high for Alphabet and the earnings report didn't overwhelm. And so investors could have just repriced Alphabet stock back down before expectations got elevated. But even though Alphabet is one of the largest advertising companies in the world, there is still room for it to grow. Consider the total addressable market for advertising. According to Statista, global advertising will amount to $874 billion in 2023. That was up by 6% from $826 billion in 2022. Their estimates suggest this figure will surpass $1.1 trillion by 2028. A growing share of that spending is moving to digital channels like YouTube, Google Search, and Instagram. Digital advertising totaled $522 billion in 2021 and is expected to reach $836 billion by 2026. It's understandable that digital advertising will grow to take a larger share. This type of advertising can be more targeted, focusing on a specific group in the population, like 22-year-old male college students or 34-year-old females with children. It's also easier to measure the effectiveness of digital advertising. How many people clicked your Amazon advertisement and made a purchase? That would be informative. The companies that will benefit from this trend include Alphabet, Meta Platforms, Netflix, and Pinterest. Additionally, companies with popular websites like Amazon, eBay, and Walmart will benefit as marketers will seek to influence the purchasing decisions of shoppers. So now that you can see how large that market is, you can understand that even though Alphabet's the biggest company in that market, there's room for it to grow even more. I also need Alphabet's price to earnings ratio. Currently, it's trading at a price to earnings of 27.31, but let's look at why price to earnings is so important. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you understand the importance of price to earnings, you can understand why that's the metric I'm using here to forecast Alphabet's stock price in 2025. Okay, so to make that prediction using the price to earnings, I need the earnings per share forecast. So according to Wall Street analysts, they think Alphabet is going to deliver $7.67 in earnings per share in fiscal year 2025. So this is the number I'm going to use to forecast Alphabet's valuation. I'm not going to make any adjustments to its earnings per share, given that this is from a collection of Wall Street analysts. So some of those analysts might think Alphabet's earnings per share are going to be better than this number, and some Wall Street analysts think it's going to be worse. So there's already a bull and bear case within this earnings per share estimate, given that not every analyst that follows Alphabet stock is bullish on this investment. Okay, so now that we have the figures we're going to use, let's go in and make this stock price prediction. So if Alphabet indeed delivers $7.67 in earnings per share in 2025, and the valuation stays the same at 27, its stock price could increase to $209 per share. Now, that wouldn't be an explosive gain from the current price of $142 per share. Still, an increase of nearly $70 would be a nearly 50% increase in 2 years. Those are excellent returns. As an Alphabet shareholder myself, I would be happy with those returns. I would be very pleased with those returns if indeed Alphabet delivers those results. But what if investors become more enthusiastic about Alphabet and they're willing to pay a price to earnings of 32? Then the stock price could rise to $245 per share. On the downside, if investors become less enthusiastic about Alphabet and they're willing to pay a PE of 25, the stock price could rise to 191, still above where it's at now, considerably above where it's at now. However, if the valuation was to fall to a price to earnings of 20, that would mean the stock price could fall to $153 per share, which would still be an increase from where the stock price is now. So you can see in all of the cases I've looked at over the next 2 years, it looks like Alphabet stock will be higher. In fact, even if the multiple was as low as 15, that would mean the stock price would only fall by about $27 per share. And this is one of the reasons why I'm attracted to Alphabet stock. One of the reasons why I've recommended Alphabet stock as my top stock to buy in 2024 is because of the risk-adjusted return. You're getting the upside with Alphabet stock with more limited downside in that it's already trading at an attractive valuation. And there is limited downside from where it can go from here because it's already relatively cheap. It's already relatively cheap according to the price to earnings, price to free cash flow, and other valuation metrics. On top of all that, Alphabet has nearly $100 billion of capacity to repurchase its stock, and it does have a share buyback program outstanding. So if its stock price were to fall meaningfully lower, that could entice management to increase its share buyback, again putting a little bit more of a floor on Alphabet stock. If it's my best guess, my estimate of where I think Alphabet stock will be in 2 years' time is somewhere between $230 per share and $240 per share would be my base case estimate for where Alphabet stock could end up. But remember, I've used a lot of estimate and assumptions here, so take that with a grain of salt. This is just my best guess using my financial analysis and my skills to make this recommendation. But no one knows what's going to happen in the future. There's a lot of uncertainty, so don't take this with any certitude that this is actually what's going to happen. It's a prediction, and predictions are often wrong. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.